Welcome back to All Things Money. I'm David Blain, and in this segment we're going to be talking a little bit about the bond market. As we mention all the time, if at any time you have any questions or comments for the show, feel free to give us a call. During normal business hours, you may not know, but we're not actually taking calls on the air at this time, so you need to call us during normal business hours at 633-0107, or simply send us an email at allthingsmoney@dlblain.com, and we'll try to address your question or topic on a future show. So we're going to talk a little bit about the bond market. And before I do, I got this little story from a friend of mine in the industry. He's a very famous industry analyst. He goes around the country and giving a lot of speeches and explaining what's happening in the markets and things like that. And several years ago, he was asked to give a speech before hundreds of people on where he felt like the stock market was going. And it was scheduled to be a 2-hour speech with a 15-minute break in between. And so during the first 45 minutes, he got up and he had all these different graphics and statistics and everything, and he proceeded to lay out this beautiful case for why the stock market was going to go up at least 1,000 points. I think this was back in 1987. And why the stock market was going to go up and how he was optimistic and everything. And then they took their 15-minute break, and he came back and he said, "Well, I have to apologize to you, but I accidentally grabbed the wrong speech, and I should have been giving you a bearish speech." And he proceeded for the next 45 minutes to use the exact same data, the exact same statistics, and lay out a very rational case of why the market was going to go down over the next year. And so my point in saying that is that when you're looking at data and statistics, depending on who you're talking to and the way you want to interpret it, they can be interpreted in different ways. And that's part of what we try to do on the show, is to give you data interpreted in maybe a different way than the regular media is interpreting it. And one of the things that we have not heard much about that we want to talk about a little bit is the bond market. First, let me just mention why is the bond market important, even for people that aren't necessarily own bonds. I recommend that most people have at least a small percentage in bonds. We don't like to invest just for the income. I think it's a bad strategy for retirees to put all their money in bonds and try to live on the income. But the reason that the bond market is so important is it dwarfs the stock market in terms of sheer size. At the end of 2009, the global market capitalization of the stock market was about $46 trillion. The total outstanding debt on the global bond market was about $82 trillion. So it's not quite twice as big as the stock market. It's a massive place for people to put their money, the bond market, everything from government, federal governments, obviously the United States, local governments, state, county, corporations issue bonds. Of course, foreign governments issue bonds. There are Euro bonds, Japanese bonds, emerging market bonds. And so the bond market is massive. And so it has an impact on the stock market simply by the fact that if people are pouring money into the bond market, they're not putting money into the stock market or commodities or real estate. And so it's important to look at the bond market because it's so big. And one thing that I want to mention before we get into what's going on in the market is how are bonds valued? Well, the first important thing to realize is that price usually moves inverse to the yield. So let's say the U.S. government needs, $1 million, and I know they need trillions, but we'll just say $1 million, and they're offering it at a 3%. Let's say it's a 5-year bond, and they're offering it at 3%. Meaning, if you give the U.S. Treasury $1 million, they will pay you 3% a year for the next 5 years. And that 3% rate is they auction these bonds off, and they put it out to market, and big companies like Goldman Sachs and Bank of America and these big financial institutions, Barclays, they bid on the bonds and purchase them. And so the Treasury, they can't go out and say, well, we're going to pay you 0% on a 5-year bond. Well, they could, but no one would buy it. And so the rates are somewhat set by the market in the secondary market. But the point is that as soon as that bond that's paying 3% is sold, once, let's say, the next month, the Treasury does an auction, and now they have to pay 4% to people to purchase their bonds. Well, the person that bought the 3% bond a month ago, they're still going to get paid that 3%, but the value is now not worth $1 million. Why would somebody pay you $1 million for your bond that's paying 3% when they can go out today for their $1 million and buy a bond that's paying 4%? And so that's important to understand that as yields go up, the price of bonds go down. Conversely, as yields go down, the price of bonds go up. Well, since 1981, we have been in a secular decline in yields of bonds. I don't know if you remember back the peak, somewhere around 1981, you could get 15.84% on a 10-year Treasury bond. That's right, 15% on a Treasury bond. And since then, the yields have come down significantly. In fact, it's almost a vertical line straight down to today, or in 2008, they bottomed out at about 2%. Well, we'll touch on a little bit more of that when we come back, but it's time for another break. We'll finish up talking a little bit about the bond market and answer some of our viewers' mail. So for All Things Money, this is David Blain, and we'll see you on the other side of the break.